I'll start the session now. So today's event, how the moving average can be utilized as a forward indicator. So to make it as a forward indicator, we need to use the volatility and Fibonacci method along with that. This is one of our innovation in the technical studies wherein we have made some changes into that method to make it more powerful, more accurate and more responsive towards your trade decision. So that is what was the aim of these changes. So why we have made these changes? Many of you will be knowing that there are two different ways to implement the moving average in your studies. One is the moving average based on their valuation. Suppose if you are taking 5 days moving average, any type of moving average you can take, exponential or simple or triangular, any type of moving average you consider. Whenever the price move above these things, above a average, you used to say that the trend is up. Some people say that 200 days moving average, some says that it is 150 days moving average. So whenever your price move above the moving average, you used to say that trend is down. Whenever the prices fall below and rule below the moving average, it is told as your trend is down. So to identify a trend is up or down, you are just taking one moving average, and sometimes the long-term moving average like 200 days moving average is used. As long as the price is above the 200 days moving average, we used to be bullish in the market. The moment price fall below the 200 days average, we used to say that yes, it has broken a bigger support, so we used to be bearish in the market. This is one method. Second is the moving average crossover. So when you compare between the 5 days and 10 days moving average, whenever the 5 days moving average rules above the 10 days moving average, or 5 days moving average is greater than the 10 days moving average, that time you used to say that trend is up. When the 5 days is less than 10 days moving average, you used to say that trend is down. So this is what this method says, that this is called as your moving average crossover. So two different ways you use the moving average. One is direct moving average itself. Second is the moving average crossover. Short-term moving average crosses over the long-term, trend is up. Short-term moving average crosses below the long-term, trend is down. This is what we are using. However, if you just use this particular concept as it is, then it's a trend decision or the decision based on this particular prevailing concept, what is there in the text. Based on this particular concept, the success rate will be maximum 50%. More than 50% we may not get. Maximum 50% the judgments will come true, if you go by the theory what I said to you. So we thought on that. We in the Smart Finance, we thought that since it is one of the best, simplest tool used by the traders, why not to improve this particular outcome? So we have just accommodated the volatility and Fibonacci. So what we have found out, what is lacking here, it is a trailing indicator, because you are taking the prices, whatever happened in the past, based on that only you are just taking an average and showing that. That is why it is giving you a lack of, or the half of the information is still hidden. Second is, it is long-term moving average responds very slowly as compared to the short term. Suppose long-term moving average, whenever we are talking 10 days, if one particular day there is a move up by 4 to 5%, though it changes the entire trading scenario, trend scenario, however, as per our moving average concept, this response very less. This response used to be very less. Means it gives a very half-baked information for our trading. So this is what the demerits of this particular method is. Then we need to move into a more accommodative method, wherein we have to find out what is the solution to improve this particular success. So that part I am going to teach you today. So I am just directly going to an example here. So what I have done here, the 5 days and 10 days moving average I have taken. I have taken for the Nifty future 27th June to 22nd July, last 30 days data I have taken. But I required only the last record, 22nd July, what happened, that is more important for me. Other things I will not take into consideration. So simple moving average means just adding of these 5 values, previously traded 5 last traded prices divided by 5. So I'll be getting the average. 10 days means same way, 10 data points divided by 10. This is how the 10 days moving average. So likewise, I have taken the 5 days, 10 days. Then I'm just concluded here 22nd July, the 5 days moving average. 5 days simple moving average is quoting at 8545, and the 10 days simple moving average, it is quoting at 8539.86. So this is what I got. So this value of 5 days moving average is greater than the 10 days moving average. This says that trend is up. This information only you are getting. So now question comes, when this trend is going to change? If currently trend is up, when this trend is going to change? So this doesn't guarantee you that yes, it is this trend is up and it will remain up forever. When the trend is going to change, that is more important for me. Currently, as per the previous data, this is what I am getting. Maybe Monday there will be a gap up or gap down. So if it happens so, then what will happen to my decisions what I have taken based on this particular method? So for that reason, I have taken the volatility into confidence. So same way, absolute return. Absolute return is nothing but your current price divided by previous price into 100. So every day basis, how much percentage of a price movement I have got in Nifty. Then I am taking the volatility parameter here. So there is a function called in Excel STDAV. So this is giving me the volatility of the past 5 days. So 5 days data I have taken. So based on this volatility, this is our daily volatility. Based on this particular daily volatility, I have multiplied this particular daily volatility with the last traded price, got the price range, Fibonacci ratios 0.2362 to 1.618, multiplied with this price range, added with the last traded price here, so and subtracted from the last traded price. All this Fibonacci price, uptrend and downtrend prices I have taken. And after taking this thing, same, I'm thinking that I'm just changing that if my price, one condition I have put it here, if my price on daily basis starting from Monday is closing any of these Fibonacci price point, downtrend price points, any of this downtrend price point or near to that, couple of points up or down from that, then how it impacts the 5 days and 10 days moving average. I have just taken the downtrend prices here. Why I am taking downtrend prices? I need to see when this uptrend is going to change to be a downtrend. That is my expectation. For that only downtrend prices I am taking. If the condition will be different, means 5 days is lesser than 10 days, then trend is down. So I would have considered the uptrend Fibonacci uptrend price points. Since currently the trend is up, I am taking the Fibonacci retracement downtrend price points, which I have derived using the daily volatility of the past 5 days data. Why not 10 days? Because 5 days is more responsive than 10 days. It is the short-term moving average. So based on that, I have taken all these Fibonacci downtrend price points, and after taking this Fibonacci downtrend price points, I have just taken the same way the 5 days averages and 10 days. Just one assumption I am making, that my price from Monday onwards is going to close near to one of the Fibonacci price point what I have calculated, couple of points up or down. With this assumption, if I am going to do that, so what happens here, I am getting, if it is closing at 8540 on Monday, so still 5 days is above 10 days. If it is 8532, still 5 days is above 10 days. Whenever this price comes to 8526, here you just see, this is the very important fact of my finding. This is the most important part of our changes. When this price going to 8526 level, 8526 level, this trend changes, the 5 days moving average changes, or 5 days moving average becomes lesser as compared to the 10 days moving average. So this is how, once we brought these changes, so currently the trend is up, no doubt about that. Go with the trend. However, this trend will change if the Nifty come to the 8526 level. Come to the 8526 level. So this is what one. So you come to know that when this trend is going to change. If currently this is a uptrend, using the Fibonacci and volatility, we are concluding that if the price 8526 below it is going, then this particular scenario is going to change. The trend which is up now will be considered as a downtrend. So this is what you got, a downtrend. So trend information you got, and as long as that downtrend prevails, you can continue with your sell side, or you can just again change your logics by changing all these price points to the Fibonacci uptrend price points and get a price point where the downtrend can change to uptrend. So this will help you a lot for planning your trade well in advance using this simple concept of 5 days, 10 days moving average. You can take any kind of moving average also. Similar way, simple moving average is just taking the 5 days data and dividing it by 5 or 10 days data, dividing it by 10. However, say similar way you can do for exponential moving average. Exponential moving average is the similar kind of things. Only thing is that there is a formula difference will be there. So the difference in formula will be current closing price minus previous period's exponents. First period will be a simple moving average, and this is the formula for exponential moving average. It is universally available everywhere. You can just do a web search and get this formula. Same formula I have just put it here, but I am doing the similar kind of changes. I have taken the volatility of 5 days, taken the price range, again calculated this Fibonacci downtrend prices and uptrend prices, and from the exponential moving average part of this one, I am finding out, yes, the 5 days moving average, which is 8543, 5 days exponential moving average, and 10 days exponential moving average is 8509. So the trend is up, and I am again doing the similar kind of calculations, and I am getting a different view when this trend is going to change. So taking all the downtrend price points of the exponential moving average, and similar way by taking the 5 days and 10 days exponential moving average, I am concluding that yes, the trend is going to change when this particular price of 8486 is going to come. So currently trend is up. However, when the price will fall to 8486.72 or 8487, this scenario will change. The 5 days exponential moving average will change to or will become lesser as compared to 10 days moving average, and this will be downtrend will start. So previously, just by looking into these averages, you have no information when the trend is going to change. However, by adding this volatility and Fibonacci principles, now you come to know at what price the trend is going to change. Currently, what is there, that information you used to get. There is no changes in that. Just by adding a new concept into that, you will be knowing that when this particular trend is going to change. So one extra piece of information what you are getting, that is very important for your hedgings, very important for your trade decisions, very important for setting of your stop losses, and it has many other implications of, you can say, setting of the targets also. So targets, as you know, uptrend targets, if this situation continues, means the 5 days will be greater than 10 days as long as the price is remaining in any of these uptrend price points what you have calculated using the Fibonacci. So uptrend price points is not important, but here you are getting the very precise information where the trend is going to change. So that difference you got in the Fibonacci by adding the Fibonacci and volatility with the moving average. So similar kind of many studies of technicals can be made a forward indicator. So these are the things you used to get in the smart finance domain. Whenever we talk about our courses, whenever we talk about our books, literatures, DVDs, all these things, whatever we sell in this domain, whenever we talk about this concept, suppose if you are taking our technical course, you are not just learning the candlestick, that 2 candle, 3 candle pattern, or how the candles are moving up or down. Whenever you are learning about the head and shoulder pattern, you are not, you will be just, maybe some other books will be giving you that if it look like this, it is a head and shoulder. But we say the real mathematics behind that. How many minimum candles should be taken for identifying this pattern? How you can calculate where the neckline breakout is there, how you can calculate the optimum targets are there. So far whatever the findings we have made in the candlestick patterns to your graphical pattern, everything we have given in a mathematical point of view. So if you possess our courses, if any one of you having our courses, must read to these fine prints so that you'll be knowing that yes, this is a dark cloud cover candle pattern, but how to validate when this pattern will fail, what if this pattern is successful, then where it will take me, what is my targets will be, and if what price point this pattern is going to fail. So that simple mathematics we have given there. It is very simple, just few additions and subtractions you need to do. That is how the difference of a true research and some copycat research is there. That is how we differ from others. That is how our stops used to differ from others. So none of this concept which has been validated by us, we have not presented those concepts in any of our book or literature. I have not written a single concept which I personally did not verify it. So this is what you can get in our books and this thing. Last time also I have taken a survey. I have asked you a question. How many of you really invested on your trading education? Some of you have told me that no, I have taken so or so courses. Some of you said that no. But I have found out overall only 11 to 12% or maximum 15% of the people just invested in their trading education. Not more than 15%. Means Each 100 traders you can take, maybe all hundreds will be using some or other softwares. However, only 15 traders has educated them. They knew how to use the candlestick. It is not important that how candlestick chart look like. It is not important that how head and shoulder look like, how to use it. It is not important that yes, I know the formula of simple moving average, exponential moving average or triangular moving average. How to use it. So this moving average tells you that yes, if the price is above this, trend is up. Trend is up means how long the trend will be up, where the trend changes. If this uptrend continue, where it will take me. All these questions are not answered in that. So that questions we have answered. Any of your head and shoulder pattern you take, you can take triple top, double top, triple bottom, double bottom. All those patterns has a mathematics behind that. That is what I used to convey. And you must learn that. So if you master that things, then only you can say that yes, truly I have learned some concept on technical studies. Otherwise not. And it is a fact, many of you used to lose more money in the trading losses as compared to their investment in their trading education. That is a fact. You accept it or not, this is a fact. So some says that I trade in options. What skill you have in options, if I ask? Whether do you understand what is intrinsic, what is time value, how the Greeks behaves, what Greeks is important for our study, and when I take the trade, what Greek I should consider, whether I should take delta neutral, theta neutral or vega neutral. These are the questions. As long as you have not found the answer of these questions, you should not trade in the options. If you do not understand what is intrinsic and time, what is the delta, vega, theta and all things, whether to use a delta neutral or vega neutral or theta neutral, then you must not touch option instrument for your trading. That's a fact. And for that, we categorically explain many things in our site. If you go to our site, our website is just like one encyclopedia. You get all things in that particular website. If you visit our website, if you browse any of our courses or this thing, so here once you go to the product details or course details, so here what you used to get, you get some information about the product, that is you got the information about the pricing of the product, that is your. However, most of the products we have given a free course. So one free stuffs we have given. What is beta decoupling, how to option pricing model, option Greeks, how all these informations you get with the elaborate explanations and video stuffs. These are the things very essential for your study, because if you do not do the study, only concentrate on profit, then this is not going to come for any time. Only concentration on profit without a proper assessment of your skill is not going to benefit you in the long run. Similarly, many calculators are being flagged here. Dynamic intraday Gann calculator. See, if you click here, you just get some values to input and other things. But here we give an elaborate discussion. What is that calculator is, what it does, and a video explanation how to use that. All these things you get in this particular calculator page for your skill development. To develop your skill, you get all this information. So that is very important. So now, using this particular concept of technical studies, we are in a process to develop a tool wherein you can just download one price data, CSV format, from your computer. Last traded price should be there. So just you have to download. sorry, just you have to upload one file format, then you can get all these things, and this particular page will be get ready in few days. Once it is ready, you will be given the access to this particular page to know the technical studies in an authentic way. So that is what the things you may get in our domain in few more days. So coming back to the weekly report, what I have, what we used to give every week. For the coming week, whatever the report we have given. So I have taken the reference of Nifty at 8,555 last traded price. And the real-time volatility estimate was 10.75. And as for this 1SD trend forecast, it is 8583 above of trend and above crossover of 8632. It can take you till maximum of 8759. Similar way to downtrend starts with 8523 and it has probability to take you to 8474 until 8346 you can expect. And this elaborate explanation also I have given what is the trend expectations and what is the range bound trend expectation. But one very important fact I am going to tell you here. Since you are in the last week of the settlement, whenever you are going for hedging, hedge it with the in the money options which will have very less time value. Hedge it with the in the money options. Do not choose out of money options which will have a greater depth and maybe losses will expand. So in the money options you should hedge because you are in the last leg of the settlement cycle. Similar way for the Bank Nifty also is being given. So Bank Nifty we have given 18,755 reference and these are the levels, and Bank Nifty based on its base value since it is a 5-digit number. So as for Fibonacci study we used to say this is the trend set point and the trend confirmation point. So once the price crosses above this trend confirmation point, enter a trade with proper hedging. That too also in the money options you need to hedge. In the money options you have to hedge, and this is also I have given here. And last week we got multiple triggerings in the stop loss hit. Last week's level whatever is being given, it has hit the stop loss because we have some GST is going to come or not come, many other events, domestic events which is keeping us in a very indecisive move. However, we can still think of a up move because put call ratio still rules above 1.10 level. Currently I think 1.10 or 1.12 in the Nifty. So as long as the put call ratio has not changed its direction, you may think that trend should be up. So this is how you should trade for next week. And if you are a hedger, if you wish to hedge the or wish to take some option strategy for your next week. So when the Nifty crosses this 8,600 level, think of buying 8,600 call. Along with, you can say 650 call sell. It's a simple bull spread. Or whenever the Nifty come to 8540 level, 8504 level, buying a 8,500 put to sell 8,450 put also, it will be very much advisable. Though risk reward you need to work out what it is comes there. Or else you can think of buying 8,000 ratio call spread, 8,600 call with 750 call option 2 lots to sell, or you can think of buying 8,500 put in a downtrend with a 8,350 put sell 2 lots. So in case the downtrend breakout, so ratio call spread also you can think of. So you can think of ratio call spread, you can think of a bull spread, you can think of a bear spread based on the trend breakout it gives. And since you are in the last leg of the last week of the settlement period also, you can think of conversion strategies also conversion strategy also, it is highly rewarding. Also you can think of calendar spreads also. Calendar spreads also you can think of. Suppose if you are getting a uptrend breakout here, so you are knowing that yes, it can have a target of 650 or 700 if it is moving up. Then thinking of buying next month's 8,700 call option by selling current month 8,700 call option. That calendar spread also you can think of initiating. Calendar, cross calendar, many strategies you can form. The simplest strategies used to reward better. So this is how you can trade next week in the option strategies also. So if moving average crossover says that if the short-term moving average is greater than the long-term moving average, trend is up. So I have taken 5 days and 10 days. So 5 days moving average is greater than the 10 days moving average, hence the trend is up. So this is what you are getting to know. But how long the trend will be up? When this trend is going to be get saturated, that information you are not getting. So for that I am just taking the help of daily volatility, taking the last traded price of 22nd July, which was yesterday, that price range, using the Fibonacci ratios, calculating all these uptrend and downtrend price points. After getting this uptrend and downtrend price points, I am taking all these downtrend price points here and recalculating the moving average with respect to these calculated points what I have derived from the Fibonacci. So after that calculations and after these changes, I am finding out when 8526 will come, that time trend will change. So that is what I am finding. That is what I am divided by previous day into 100. So this will give you absolute return. So similar way you just calculate all absolute returns, and post calculating the absolute returns just use STDEV, the standard envelope function used in the Excel. Take the 5 days of absolute return, you will get the daily volatility. So just multiply that daily volatility with the last traded price, you will get the price range. Use the Fibonacci ratios and add it with the last traded price and subtract from the last traded price. So you will get the uptrend Fibonacci points and downtrend Fibonacci points. When this 5 days is above the 10 days moving average, use the downtrend price points and recalculate all moving averages. When this is 5 days is lesser as compared to the 10 days, use all uptrend price point and recalculate the moving averages. You will get to know where this moving average, at what price point this moving average situation is going to alter. This trend is going to change. So this is what this particular method is. Through this session, I wish to convey many of you are using the moving average in its crude form. Just try to use it in this particular form by introducing the volatility and Fibonacci. You will find out the success ratio of this particular method will be more. That is what I wish to say. Many of you know how to use moving average. Just use this method along with the Fibonacci and volatility. You will find out the success will be far better as compared to the crude form use of the Fibonacci and crude form use of the moving average. This is what I wish to convey in this particular session. Once more I will repeat here. So how this is the daily volatility is being taken and previous days last traded has been taken. So you can understand in this term, this is not a weekly forecast on all. On Monday, if the Nifty future open below 8526 as per this simple moving average and Fibonacci, then the trend is down. The moving average has changed its direction. So change its direction. Once it is changing its direction, you are expecting 8466. The maximum it can come as per this Fibonacci levels. So this is how you should understand this particular method. But without this method, what information you had on moving average? It is 8545 is above this So trend is up. When the trend is going to change, you do not have the information. If the trend changes, then how long it will go? That information you did not have. If the trend continues, where it will go, that information also you did not have. So by introducing this part of Fibonacci and volatility, you come to know that trend changes at 8526. If this trend changes, it has maximum probability to take you to 8466, and these are the intermediate levels: 8519, 8510, 8505, 8486. All are the valid targets. However, if the uptrend resumes above 8552, then it has all probability to take you to 8586, then 8595, 8600, 619 and 639 maximum. This is for the day trade only from Monday. Only valid for Monday. Monday the new record you will get, new price you will get, calculation will be different for Tuesday. So this is how you should utilize this particular moving average improved concept for your trend forecast.